In this video, I will discuss 3 high-growth stocks to buy right now. I have been looking at hundreds of stocks over the past few months, and these are the ones that really caught my eye. Now, they all have great fundamentals, and they are all growing at an accelerated pace. So what we're going to talk about is the valuation. We need to know the intrinsic value of these companies first, and then we can look deeper. So second, we will look into the company overview, what it looks like, why I'm so bullish on it. And then third, we will look at the chart to see if there is a good entry. Now, combining the story and the numbers together provides a more in-depth analysis. So if you've been watching this for a long time, watching this channel, then thank you so much for all of the subscribers. Please comment down below what stock you would like me to do a deep dive on, because I would love to research another stock for you. Let's get started on this video. The first stock is Zillow, which is reimagining real estate. Launched in 2006, it is the top real estate website in the US and is building an on-demand experience. Looking at its latest quarterly report and annual 10K, we can find out the fundamental health of this company. This is incredibly important, and if the numbers don't match up, then we don't need to look any further. So first is revenue growth. The top line on average has grown 52% every year for the past 10 years, which is incredible growth. Note this growth has slowed to a steady 20% on average over the past few years as it has gotten larger, which is of course expected. Market cap is $25 billion with an EPS of 0.6. This shows that even though they are a high growth company, they are using their cash responsibly. EBITDA growth has grown 32% annually over 10 years. This means margin has grown very well. Enterprise value over EBITDA is much lower than last year as growth has grown and the price has gone down 50% from its highs. This is exactly why it may be a good stock to put on your radar. Free cash flow is cash flow from operations minus CapEx, or capital expenditures, so assets minus expenses. We have a slightly volatile cash from operations, but it has increased over time. Now, shares outstanding has grown 11% each year, meaning there has been some share dilution. They issued some convertible bonds, so we count this dilution in shares outstanding. This is expected as an early high growth company, but it is something to be aware of as an investor. Zillow is expected to have an EPS of $1.29 in 2022 and 1.74 in 2023. According to the 10-year conservative DCF, the price is fairly valued for a 10% ROI at an intrinsic value of $95. Current ratio is 3.82 and debt to equity ratio is 0.45. Optimal debt to equity ratio is under 2. This is great because it means that the assets are more funded by equity than by debt. So what does Zillow do and why am I so bullish on this? Zillow handles all things housing, whether selling, buying, renting, or financing. The process is super easy and fast. In addition to listings, Zillow offers options to buy and sell homes directly, cutting out the middleman. Zillow Home Loans offers pre-approved secure financing for home purchases. Other companies Zillow owns is Truly, Street Easy, which I see on subways all the time. I love the marketing to the younger generation, and Hotbeds. In Q2, it announced $1.31 billion in revenue, 229 million average monthly unique users, and 2.8 billion visits to their main page. Zillow has the best of both worlds, and I'm super bullish on this company because it's a tech company, which means fixed costs are low and it benefits from the ebbs and flows of the housing market. They benefit in a seller's market and a buyer's market. They have recently started to expand globally as well. Its latest solution is Zillow 2.0. The mission is to create a radically simpler real estate transaction through technology, service, and integration. Zillow intends to vertically integrate the entire housing process. With more people working from home and low interest rates, Zillow has benefited from increased home sales. The Federal Reserve is unlikely to increase interest rates in the short term. The Fed is also unlikely to start tapering until next year, as we heard Jerome Powell say last week. Once they do start, Zillow may face headwinds, but that's still uncertain. While the stock is down almost 50% from its all-time highs, it is still set for a profitable full year 2021 with a $5.5 billion in estimated revenue. The largest source of revenue comes from directly selling and buying homes. One of its biggest opportunities is the Premier Agent, which replaces the traditional agent. This is a SaaS tool which lets brokers advertise on Zillow, generate leads, and manage workflow. The company boosted 8,258 homes were sold over the last 12 months. Wow! Now let's look at the charts and see if there is a good entry. On the 1-year chart, Zillow is slightly up yield to date. It has been trading sideways with a key support at $90. Zillow has good trading volume and recently broke out of a descending triangle to the upside. If buyer momentum continues, now could be a good time to trade this stock. If you are looking long-term, a price of $95 or lower offers a great risk reward. Analysts rate this as a buy with a $164.50 price target or 15% upside. I think this is a great stock to hold long-term if you want to be in the housing space while having a disruptive technology. While the stock may seem overvalued at the moment, it is expected to grow 40% in 2022. Their TAM, or total addressable market, is the total value of all homes in the United States, which is $2.2 trillion. So even if they get a small percentage of that, that's still huge. This creates a great long-term buying opportunity for a leader in the high-growth new iBuying sector. With a good ROI and fast growth, this is a great stock for long-term investors who are interested in the housing sector and innovation. The next stock on the list is Microsoft. This behemoth needs no introduction as a leading global software company that started with its breakout product Windows in the 1980s. Oh my gosh, I still remember Windows 94. I thought it was so cool getting that. That aged me a bit. Looking at its latest quarterly report and annual 10K, we can find out the fundamental health of this, and you will be really happy with this. First, revenue growth. The top line on average has grown 10% every year consistently. Nice steady growth. This is great for such a large company. Market cap is $2.2 trillion and has a modest dividend of 0.74%, which is great, with an EPS of $8.05. EBITDA growth has grown 12.8% annually over the 10 years. This means margins are growing, with a profit margin currently at 36%. That's why we love tech companies. Enterprise value over EBITDA is 25.8 versus the industry average of 26.8. This is a little high from its historical value, but I will explain why this is not a problem in a bit. Free cash flow just looks beautiful, and they are reigning in money with $56.12 billion and growing at an accelerated pace. Shares outstanding are going down 1% per year. That's perfect for investors to get a bigger slice of the pie. Microsoft is expected to have an EPS of $10.07 in 2022 and $11.42 in 2023. According to my calculations of a 10-year conservative DCF, the price is fairly valued for an 18% ROI at $275. Its current price is $303. Current ratio is 2.08 and debt to equity ratio is 0.41. Now let's look over at the overview of the company so we can see how Microsoft continues to expand and lead to accelerated growth, which involves AI and their Azure. Today, it has a wide variety of offerings, folks, such as its Microsoft 365 program suite of productivity software, Azure Cloud Computing Service, Xbox, and Windows. Microsoft 365 program is incredibly sticky because it offers a fully integrated suite for corporations, which means they have a huge moat. Their commercial business grew 30% year over year, and their commercial cloud business grew 36% year over year. It is segmented into productivity and business processes, intelligent cloud, and more personal computing. Total revenue for the Microsoft 365 and cloud services grew 25%. LinkedIn, which they own, grew revenue by 46%, and Dynamics grew by 33%. Its cloud company, Azure, grew by 30%, showing no signs of slowing. Windows OEM and Xbox, yes, they own Xbox, grew revenue by 9%. So if you thought they weren't growing enough, recently the company announced its release of Windows 11, which is why I'm incredibly bullish in this company. Beginning October 5th, Windows 10 PCs will receive the free update. Analysts expect this new system will increase profit margins by 19%. The update includes a store for apps that take a 15% cut from developers. This directly competes with Apple's 30% cut they receive from developers. Now let's look at the charts to find a great entry point. The 1-year chart shows a great growth trajectory, and this is exactly what we look to see as long-term investors. The trend is your friend. Microsoft has great relative strength, yet it seems oversold on the weekly. I would not personally trade this at the moment due to more selling pressure and an overbought RSI. And of course, I mean, it seems overbought on the weekly. A good entry point for long-term investors would be 290. That seems like the next support. However, if you are willing to have an ROI of 16%, you can enter now with a starter position. Analysts rate this as a strong buy with an average price target of 328%. And yes, that is after the fact that it has exploded in growth. Microsoft is still growing like a mid-cap stock with second quarter revenue growth of 21% year over year and net income up 47%. I am incredibly intrigued by this company right now because of the launch of Windows 11. Once announcements start in October, we should see a huge spike in the share price. And even though this company is a large cap stock, it is growing fast. I believe this is a great stock to buy and hold forever in your portfolio with consistent high growth return. Last stock on this list is Lockheed Martin, or ticker symbol LMT. This is a very diversified company and is a leader in the aerospace and defense sector, which we know are high growth sectors. Looking at its latest quarterly report and annual 10K, we can find the fundamental analysis. First, revenue growth. The top line on average has grown 4% every year, very modest, very steady. The market cap is $98 billion and an EPS of 25.51%. EBITDA growth has grown 9% annually over 10 years. This means margin has grown very well. Now, this is a very large, mature company, so we're not going to see that double-digit growth. Microsoft is kind of a unicorn when it comes to that, but it's a very safe and consistent stock. Enterprise value to EBITDA is lower than competitors and lower than its mean at 10.25. Free cash flow. So we have a slightly volatile free cash flow, but it has increased over time. Please note in the last quarter, they had a loss of $225 million net earnings due to a one-time performance issue. They couldn't really talk about this during the earnings call because it was a government contract. Shares outstanding is decreasing year over year by about 2%. This is wonderful for investors because it means each year investors are getting a bigger slice of the company's pie. Now let's go over to price to shares. This is a good metric to look for the defense sector because sales tend to be more consistent over time than earnings. Price per share ratio is 1.49. Lockheed Martin raised full year guidance and EPS is expected to grow to 28.05 in 2022 and 29.45 in 2023. According to my 10-year conservative DCF, discounted cash flow, this is what we do for forecasts. The price is fairly valued for a 15% ROI at $354. Current ratio is 1.35 and debt to equity ratio is 1.86. Let's look over to the overview of the company. It designs, manufactures, researches many tech, including AI, defense aircraft, and long-range communications tech. The company breaks its business down into 4 segments. We have aeronautics, which is about 40% of sales, rotary and mission systems, which is about 25%, space, which is about 18%, and missiles and fire control, which is 17%. So last quarter, the total revenue was $17.03 billion with a net income of $1.82 billion. They also raised guidance for full year EPS. Lockheed Martin is very innovative and recently developed a high-performance, low-cost hybrid antenna. This is called the wide-angle ESA Fed reflector, or wafer. This bolsters current 5G radar and sensing tech. Coverage area is 190% greater than traditional array antennas at a lower cost. While over-reliance on the U.S. government is a worry as this is their main customer, the necessity of military spending will always be there. While this may be a risk, contracts are drawn several months in advance, so you always know what you're getting into. Let's look over at the charts. On the 1-year chart, LMT is a down yield to date at 358. If we zoom out to the 10-year chart, we can see that this stock is in a consistent uptrend, which may lead to a good opportunity for value investors looking to increase dividends. Looking at the weekly, the stock may be good to trade in also. The volume is high and it is at a key support level. If it bounces off of the 200 MA, it may be a great entry point for a trade or even for long-term investors. Many investors love the stock because of its 2.92% dividend. It's definitely a dividend aristocrat, and analysts rate this as a buy with a $423.89 price target or an 18% upside, which is a little more bullish than I am, but I like to be conservative and have a margin of safety. In my opinion, this is a great stock to own for long-term investors for the defense and aerospace sector. If you don't have that in your portfolio, you might be able to add a few shares on this nice little dip we're seeing. It is a growing company and it provides a great dividend for its investors. If you are looking for a reputable company that provides a great dividend, this is a good stock to own. So these are my top 3 high growth stocks to buy now. So we had Zillow, which is disrupting the iBuying space, which is a new space for the housing market. We had Lockheed Martin, which is in the defense space. It's a nice value and dividend play. And then we also had Microsoft, the huge behemoth, which has Azure and is just growing rapidly. This should just be something to hold forever. Now, if you don't have time to be an active investor, which means researching daily, looking at the news daily, I would recommend always to have index funds and ETFs to be mostly your portfolio, at least 80%. These individual stocks can be about 10% to 20% of your portfolio if you don't have time to keep up with them. But if you do, these are 3 great plays to think about. Now, be sure to subscribe and hit that bell notification because on Fridays at lunchtime, we always meet and we are going to look at the top 3 high growth picks for e-commerce next week. So if you want to see what's going on with, let's say, Shopify or let's say Lightspeed, then be sure to check that out. As always, I have a lot of social media, all the things, and I post regularly there. So come visit me at all of my socials in Instagram, on Twitter. We do a lot of news and a lot of help with stock picks, and click the link in the description below for your free newsletter on all things finance, money, and investing. Have a wonderful and blessed day. Please be safe, and I love each and every one of you. And let me know in the comments what you would like your next stock to be. Have a great day. Bye.
If you would like 2 free stocks and to support the channel, sign up for Webull, link in the description. And as a bonus, get a free year membership to the Sober Girl Investor community where we learn how to be wealthy and save the world.